Hi, everybody. My name's Clayton Portz. I'm a startup advisor and venture fellow here at Newchip. Thank you for joining us in today's session for Demo Week. We are here with Andrew Gazdecki to discuss the reality of startup exits. I would like everyone to welcome our special guest today, Andrew. Andrew is a four-time founder and has 3 exits of these 4. He's a former CRO, and he is the founder of MicroAcquire. Andrew has been featured in a number of publications, including the New York Times, Forbes, Wall Street Journal, Inc. magazine, and Entrepreneur magazine, as well as prominent industry blogs, including Mashable, TechCrunch, and VentureBeat. And we are so excited to have him here with us today. Andrew, thank you for taking the time to join us. I'll tell
Yeah,
you what.
thanks for inviting me. And thanks for that awesome intro that I wrote myself. I appreciate it.
Of course. So let's just jump right in, Andrew. Why don't you give us, a little bit more in-depth look into what MicroAcquire is? What service are you providing to the startup landscape, and how could startups, use the service and look at as they look towards exits?
Yeah. So, by way of background, I've had really two what I'd consider major acquisitions. The first was a company called Business Apps that I started in college. Sold that to a private equity firm, and then started another company after that in the blockchain space, which I sold to Strategic. We'll get into the difference between those two, but through those two acquisitions, I just kind of learned just how hard it is to get a startup acquired. Meeting buyers is super confusing, understanding what buyers look for. And so I created MicroAcquire as a way for startup founders to simply meet with buyers, meaning it's completely free. You can create an account, there's no commissions, there's no brokerage fees, and founders are able to build relationships with buyers at their pace. So if you're a founder and you're in a situation where you need to sell your company immediately, maybe you're running out of money or you're burnt out or something like that, you can list it on MicroAcquire Meet Buyers. Or if your company's doing really well and you just kind of want to get feedback from buyers, see what the market would value your company at, you can list it for free and get instant access to about 30,000 different buyers at this point.
That's interesting. Do you mind kind of sharing some of your experience with the exits you said you had? I'd like to hear about your experience, and what's some of the takeaways you took from it?
Yeah, so the first one, I think a lot of founders might be able to relate to this, but there's this saying in startup land where startups are bought, not sold.
Right.
And the founder dream is Google shows up to your door, they have a big check. It's like, you just won the lottery, we're going to acquire you. And that happens, but only for the 1% of the 1% of
Sure.
startups that are growing like crazy. And for the other 99% of startups, they're typically sold. And so it took me, a couple failed, attempts at selling my company to really understand that, building how important building those relationships in advance are. But that was probably the biggest learning lesson was if you want to sell your company, you need to do things in advance and you have to kind of express that you are for sale. I think a lot of founders kind of have this notion in their head that a company is just going to randomly come to them one day and say, "Hey, we'd like to buy you," and that's a very rare occurrence. If it
Yeah.
happens to you, you've won the lottery, and hats off to you. But for the majority of founders that I know who have successfully sold their company or been acquired, they ran a process. They built relationships in advance. They prepared their company for an acquisition, and they just kind of understood, especially why people buy companies, whether it's a financial buyer or a strategic buyer.
Yeah, Andrew, if you don't mind, walk us through the difference between a financial buyer and a strategic buyer.
Yeah, so a financial buyer would typically be a private equity firm. And so they're really looking for, profitable businesses, ones that are generating a large amount of cash flow, Traditional PE will look at revenue thresholds of 10 million at a minimum. There's been an emergence of micro PE funds that are looking lower in the market. But once you get above 10 million, that's when bigger traditional private equity firms get really interested in your company. And a strategic buyer would be the ones you read about mostly. So that'd be Apple, Google, Facebook, companies that are essentially buying your business because they see it as a future, new line of revenue, a new product that they can, launch to their customers. And then a private equity group or a financial buyer is buying your company to maybe grow it a little bit more and then sell it to, maybe a strategic potentially, or just hold the company. A lot of private equity companies will buy companies, hold them for the long term, and essentially optimize expenses, make them more profitable. There's a tons of different models, but the short answer to that question is a financial buyer is really looking at, the revenue of the business and how can they see a return over, 3, 4, 5 years based on the revenue of your business. And then a strategic is a company that's looking to take your product in and essentially sell that to their existing customer base.
Yeah, it's interesting to think about these buyers and the idea that they can actually the process could run in tandem. You could consider possibly strategics and financial buyers at the same time, right?
Absolutely. I mean, they're both great outlets to be acquired. The valuations are typically different between financial buyers and strategic buyers, in my experience.
What do you mean by that?
Financial buyers will typically pay lower multiples because they're looking to see a return in a different way. So they're looking to see a return by cash flowing the business and then paying the purchase price back over a period of typically 3 to 4 or 5 years, depending on the firm. Or they're looking to grow it and then resell it. And then a strategic company will tend to pay a higher multiple. And this is when you hear like Salesforce bought XYZ company and they paid, 20x annual recurring revenue or something like that. They're essentially
the beauty
making
of
a bet.
synergies, right?
Yeah, there's some, synergetic, alignment in the business, and they see this as a core offering to their current customers. And so the short story there is sometimes a strategic buyer will be able to have a lot more value when they acquire a company than a financial buyer.
Right. Yeah. The when you look at a strategic buyer, they might already, or they likely will already have a plan in place of how can we increase the revenue immediately, or how can we cut costs immediately. Whereas some of these financial buyers, that might have to happen over a bit of time. And I'm curious, so what does the process look like when I'm considering it's time to sell, right? And I'm not sure exactly what who the right buyer is for me. Maybe I have some thoughts in mind, maybe on some strategics. What does the typical process look, and how does it change when they work with a company like MicroAcquire?
Yeah, so I'll start with maybe the 3 ways you can sell your company in my mind. One is on your own. You can establish the relationships with strategic buyers, private equity companies that buy SaaS companies or businesses that are similar to you, and reach out to them and build that relationship early. And the second route would be hiring, say, an investment bank, and that's more almost like a realtor where they're going to, basically be your M&A advisor and reach out to strategics and, private equity firms on your behalf. And then MicroAcquire allows you to kind of be in the middle where you meet with buyers directly, but it's a lot faster process. So instead of reaching out to people or companies or firms one by one, when you list on MicroAcquire, you're essentially showing private details of your company to a very wide audience of buyers. So that could be everyone from, a strategic buyer to a financial buyer to even, successful entrepreneurs that have exited and are just looking to acquire a company to operate themselves independently. So through MicroAcquire, you tend to expose yourself to a wider pool of buyers and faster. And then if you use, say, an investment bank, they're going to, charge a commission for their services, which can be well worth it. They can help increase the price. They can make sure that you can stay focused on running your business. So yeah, you can run your own process. Hire an investment bank. Then with MicroAcquire, allows you to reach more buyers, a more diversified pool of buyers faster than you typically would on your own.
Yeah, so if I'm looking to sell my company and I'm a little hesitant on what information I want to put out there, what information will MicroAcquire send out to these potential buyers?
So it's completely private, and the reason it's private is when you tell your team that you're being acquired, you get some really interesting reactions. Everything from "Am I getting fired?" to "Am I becoming a millionaire?" and everything in between. And then your customers too, they're going to wonder, is this service going to be deprecated? What's happening? So when you're, approaching potential buyers, the last thing you want to do is have your team or your customers find out until you're really sure that this is the right move for your business. So on MicroAcquire, really the only things that you're listing is a vague description of your company, your general revenue metrics. How much are you generating in trailing 12 months revenue, trailing 12 months profit, how many customers, just high level details. So as a buyer, they have an idea of what space are you in, what type of company are you, how big are you, how many employees. And then when buyers want to know more information, they would request additional access information. And then as a founder, you get to approve or deny that access. So you have full control over who sees the name, the URL, and the contact information of your business. So you basically get a pretty vague profile, and then buyers see that they have enough information to wrap their head around it. And if they want to contact you for more information, you can vet them on LinkedIn. You can ask them questions, have them sign an NDA, and then grant them access to a mini data room, essentially.
Yeah, I'm curious too. How in depth do you see these data rooms get when you, that's one question I get as an advisor a lot is, what all should I have in my data room? But when we're going to get acquired, the level from an early stage investor to a potential exit, that data room could grow exponentially. Is there anything that you see is absolutely crucial to have in the data room that a founder might not think about?
Yeah, I think it depends on the size of the business. The smaller the company, typically the messier the data is going to be. But even just a simple P&L is probably the number one thing I would require or recommend for founders to include, because that gives a full picture of how the business is trending. Is it growing? Is it declining? Is it flat? How is customer churn looking? Where are you spending your capital? How are you growing the business? Are you spending heavily in marketing? Is there ways to potentially make the company more profitable? It just gives a good, healthy picture of the business. And then other items could include just a pitch deck, a general overview, and then the list can go on and on and on. But I generally recommend just a P&L and a pitch deck just to start the conversation. And then if it gets more serious, you can begin adding more information based on buyer requests.
Right. And does the due diligence process, while it will be similar to, say, the due diligence process that some of these founders might face in some early stage venture capital deals, does the due diligence process differ on, say, MicroAcquire, where it might be different with working with an investment banker?
Typically, no. Okay. So MicroAcquire simply just connects founders with potential buyers, and that's it. And so the due diligence process will really be determined by the buyer. And some buyers will have terms such as a quick 30-day due diligence process, all cash deals, 90-day transition for the founder. Some strategics will have a much lengthier, due diligence process. It really depends on the buyer. And then it could include an earnout. There's a lot of variables, but typically due diligence doesn't necessarily change, but the time to get to, say, an LOI is a little faster with MicroAcquire because you can integrate things like Stripe, Chartmobile, Barometrics, Google Analytics to get, a healthy snapshot of your business. But due diligence is still a headache. It's still something that you have to go through, and it's one of those things where it's not going to be the funnest thing you've ever done, but luckily, if you're selling your company at a price that you're happy with, you're going to see a nice reward at the end.
Mm-hmm. And how long, if I'm going to sell my business and I'm working through MicroAcquire, how long should I expect this process to run, and what might shorten the process, what might lengthen the process?
Yeah, great question. So I would say the biggest hurdle when selling a business on MicroAcquire that I personally see is number one, the quality of the company. Is it growing? Is it, flat, declining? Is churn through the roof? And then second, is it priced correctly? If founder expectations are, we're doing $1 million in revenue, I think this is worth $30 million. That's going to lengthen the process by quite a bit because that's way outside of normal SaaS valuations. So just understanding what market multiples typically are is key. And then also just being prepared. So showing buyers that you're serious about potentially selling your business by having the necessary information. Also doing things like, having an attorney ready, having a CPA ready with, again, a P&L that's, been verified as correct financials for your business. Things like that just show the buyer that you're serious, because most buyers, and I think a lot of founders don't realize this too, is most buyers are looking at a lot of deals every single day. So in a strategic, the person that's going to be buying a startup, their title is corporate development, which basically means I buy companies for, the company I work at. And private equity, same thing. And their whole job is to look at different startups. So the more you can appear that you're not going to waste their time, that you're just kind of sort of interested, unless again your company is a true diamond in the rough and it's something that is of high value. The more you can just show that you've done your homework, you've prepared materials in advance, that should at least give buyers some indication that you're serious about doing a deal. That would speed up the process. And then lengthening it, to go back to what I was talking about originally, having expectations around valuation that are too high, not providing enough information, and then sometimes just having a business that isn't doing well is going to make it tougher. If you're losing money, maybe you've raised too much venture capital where there's going to be a lot of approval involved in terms of getting a deal done. Those are some things I've seen delay deals and then also speed up on the other end.
So how much would say previous investors or potential board come into play regarding an exit?
So MicroAcquire, I tend to try and focus on bootstrap companies, ones that have not raised a lot of capital. And the reason being for that is there's just less red tape to get approval to sell the company. If the founder owns the whole business, they're the decision maker and they can make the call on whether or not they want to sell the business. And when you raise a lot of capital, the amount in which you need to sell the business, the bar is raised. Even if you raise, say, a $5 million Series A or something like that, you need to see like a $20 million exit to even break. I'm generalizing a lot right here, but those businesses are just really hard to sell, especially on a platform like MicroAcquire. So in those situations, sometimes I talk to founders and I say, hey, you might want to keep going for another year, build those relationships with strategic buyers. So yeah, I hope I answered that question, but
yeah. I want to back up a second for sort of the length of how this process would work. Okay, I have a great business, right? It's gonna attract a lot of interested buyers if I wanted to go out to a broad spectrum of interested buyers. How should I go about considering who to meet with, how many potential buyers to meet with. Is there any advantage to running a very narrow process or running a very broad process where I'm meeting with 100 or more potential buyers?
Yeah, that's a great question. So the number one thing I tell founders when they start a process is don't take your eye off growing your business. You want to continue to grow. You want to continue to make sure your business is operating in a healthy manner. And really, when you go out and you start a process, there's a saying where if you have one buyer, you have no buyers. So you really want to bring as many buyers to the table as possible because you'll get feedback on your business, what certain buyers are looking for, what they like, what they don't like. But increasing the odds of actually getting your company acquired, bringing as many buyers to the table as possible is definitely the route to go. And, which ones to focus on, it depends on the size of your business. Obviously, if you're doing 10 million a year, you're growing, double digits, triple digits year over year. You're going to have a specific type of buyer profile, and you should map that out beforehand. So you're not wasting your time.
Yeah.
Speaking with people that can't transact, an 8-figure business.
Yeah, that's great. And that can actually even be applied to the VC world too, right? You want to narrow that focus down. While it is a numbers game, the funds that invest very specifically in your industry, the ones that have the cash on hand to invest, and so forth, could increase the likelihood of a good investment at a good valuation. I think that speaks to both VCs and strategic buyers as well. Yeah, I want to maybe go a little bit further into the even so after the process happens. I sell my business, whether it be to strategic or a financial buyer. What happens to me as the founder, as a CEO? What are sort of some of the pathways that could happen? Do I just leave and retire on an island somewhere? What else could happen in that situation?
I could tell you from like personal experience.
Sure.
If you're, an entrepreneur, and you're looking at, potentially selling your business, I highly recommend trying to think about, what are you going to do next? I know a lot of entrepreneurs, for some reason, you sell a business and then you immediately go and start a new business. And sometimes it's good to take a break and figure out and think really where you want to spend the next, 10 years of your life. So that's just some personal advice if you are at a point of an acquisition. And depending on the terms, and I'll get to that. Depending on the terms, my acquisition for business apps was a 90-day transition. I negotiated that during the negotiation period where basically I wanted to move on to other things. I'd ran the business for about 8 years, which is 40 years in startup land. So I probably got some gray hair from that business, but there's things that you can do if you're okay staying on. Sometimes there's earnouts. Those can last up to 2 years. Sometimes it's 6 months. Sometimes it's 12 months. Sometimes it's a 90-day transition with a 6-month consulting agreement on top of it. It really depends on the buyer. For a strategic buyer, you can definitely expect 1 to 2 year earnout. And what that means is your new job now, you just sold your business, you're celebrating, but you also just got a job. So now your job is to integrate that business into this larger organization, and you'll get a title like general manager or something like that. And that's okay. That can be amazing outcome. And then for a private equity firm, sometimes the terms can be, hey, we're going to take the business. You can stay, you can go, whichever one you prefer. We're going to do all cash up front. So it depends on the buyer. And that's a big negotiating piece as well. And one thing I think that's really important too is understanding the terms when you do sell your business, because if you do, if your acquisition terms are, 50% cash up front and then 50% earn out over, projected numbers, and you miss those numbers, then you might not reach that, final number that you were expecting to hit. So all cash deals can be favored over, earnouts, just depending on how your business is growing, the state of it, but also where you are personally. Because selling a startup, something you've really put a lot of, blood, sweat, and tears into. It's kind of an emotional process. Like, it's not just like, hey, I'm done with this thing. It can be, but you still have these like emotional feelings of, are you okay selling a business and having someone operate it, and you're an employee for someone else that owns it for a period of time? For me, as an entrepreneur, I knew I just would not survive that. So I didn't want to risk, 50% upfront, earn out, and then I don't even get to the end of it. And then, so that's something to think about, personally as well. Like, if you sell to a strategic, can you work inside of a larger business? Some entrepreneurs can, some can't. But in terms of your question, long-winded answer, but it depends on the buyer. Typically with financial buyers, they'll be more straightforward in terms of you can stay or you can go. It's up to you. Strategic buyers will typically require some sort of earnout for you to integrate the business into theirs.
Yeah, that's one thing I was hoping you would mention, because what we tend to find is a lot of founders might think that, when I sell my business, I'm out. I have to go move on to the next thing. I either ride off into the sunset, I start another business like yourself. But a lot of times you're in a situation where you do have to stick around and kind of help with this integration process, and it might take a year or two or three. And also for anybody that might not completely understand that earnout aspect, the earnout is, say, you get $10 million for your business, and 50% is cash, 50% is earnout. That means $5 million you get cash up front, and the other $5 million you get when you hit specific goals during the integration process, is typically how those earnouts work. And Andrew hit a few points regarding the earnout there, that it's fairly typical to see that type of structure in a strategic deal.
Yeah, and one thing I'll add too, and again, that if you sell to a strategic and the valuation they give is higher than, a financial buyer, but it comes with earnout, could be a fantastic outcome for you as a founder. But I've had friends that like are literally counting down the days until their earnout's over. So, something to really think about. I think a lot of people focus on the number, but I think terms can be just as important.
Absolutely. Great point. So flipping the script here a little bit, I want to get back to maybe some of your exits. What is the, you earlier you mentioned, a couple things that stood out to you, but what was the biggest surprise you had? What was the hardest part? What was the easiest part about selling your businesses?
So with business apps, I would say I had no idea what I was doing. So there's just not a lot of, information on like, how do you get acquired? What do buyers look for when they acquire you? You just kind of say like, so business apps was a mobile app platform for small and medium sized businesses. And so I would think, hey, GoDaddy or Web.com or Endurance International, you have like millions of small business customers. This is a no-brainer for you. But a lot of times within strategic companies, the corp dev works really closely with the chief product officer. So they have a roadmap over build versus buy situations. And so they receive all these inbound requests, but it's pretty rare for strategic buyers to jump on a business depending on. So I guess what I'm trying to say is I just thought, this company was destined to end up in the hands of one of those businesses, and they would approach me. I thought I just need to wait. I need to be patient. This is a perfect fit. But that clearly wasn't the case. And then we eventually sold to a private equity group. And so I was very surprised at just how important a CFO is if you're selling your business. Just being able to deliver, clear financial reports, and that builds a lot of goodwill within with the buyer that you're potentially selling to, that these numbers are accurate. And some of the requests that, depending on the size of your business, some of the reporting can be pretty complex if it's a large transaction, and rightfully so. They want to, due diligence the business. So I would say biggest learning for me was just how long it took to get a deal done. As an example, the first interaction I had with the private equity firm that I sold to was 4 years prior to actually getting the deal done. We had, kind of crossed paths here and there, but it took a long time to get the deal done. So
Right.
learnings would be, strategics sometimes will come to you, but it's good to build those relationships early. And then also just to be patient, and focus on growing your business over everything. And then I would definitely recommend having a CFO or a VP of finance or a controller, someone that can, really paint that financial picture to buyers.
Yeah. So you've mentioned a few times now, obviously strong financials is probably one of the first and foremost, traits that a potential buyer might look at, right? If you have strong revenue numbers, maybe you're profitable, you're growing. What are some other traits that, let's say I have good numbers, I have okay numbers are irregardless. What are some other traits that a buyer would look at into a company to say, we like these guys, we're going to buy them?
Sometimes it could be just the relationship. Warren Buffett has a great quote where he says you can't do a good deal with a bad person. So sometimes just, they get comfortable with you and your business and they understand it. In terms of other traits, product synergies for strategics is a big one. If you sell to, SMBs and the strategic company sells SMB, there could be a win there. But things just fundamentals like, are you growing? Do you have, a good grasp on, your lifetime value? Is your customer acquisition cost, LTV to CAC ratios? What does that look like? Is churn low? Is it essentially a healthy business? And then also what you built too. Is what you built super novel? Is it in a market where it's commoditized, where maybe there's a lot of other competitors? And if there's a lot of other competitors with very similar businesses, then obviously the potential buyer is going to look at those and compare you to them. So strength of team, strength of product, strength of business model, and really, do you have some sort of competitive advantage over other players in the market? I think is huge, and that could be a distribution strategy, your product, your team. There's a number of different factors, but something that makes your company unique and valuable, I think, is key. Instead of being just very similar to 20 other businesses, which isn't a bad thing, but you'll definitely stand out more with buyers if you have and you understand what makes what your unfair advantage is in the market.
Of course, not terribly different from sort of the VC stage. Some of the things they look at, except they private equity buyers and strategic buyers, they don't do as many deals and they can't afford to take as much risk as say some early VCs would. So they're going to be a little bit more diligent about some of the things that they're looking at.
And one other thing I want to add too, that I from your previous question in terms of, and I'd love your thoughts on this too. So
of course.
I always thought when you sell a business, you want to do this dance of like, we're not for sale, but like we totally are, but like we're not. But when I eventually sold, so business apps, when I sold that business, I was very upfront. I said, we're, definitely open for a strategic partnership or a sale. But just being more upfront and transparent, again, just showing them I'm serious about doing a deal. Where can we, and then the negotiation starts. Second business I started, I mapped out the strategic buyers pretty much when we launched the business. I built that one to sell. But basically just, vocalizing that you were open to a sale, I think is important. And I've heard some people say, no, you want to be a little bit more reserved, so you seem like you're off market. And that kind of bleeds into the quote of, the best companies are bought, not sold. But in my experience, I've found that just the more upfront and direct you are with what you're looking to do with your business can help speed up an acquisition if that's what you're truly looking to do.
Yeah, it makes sense, especially because like you've already mentioned, you know, companies are oftentimes not bought; they're sold. So you have to, of course, put it out there that you are for sale if you don't have all these inbound offers. And even if you do have inbound offers, you can go to some of the strategic buyers or even financial buyers that you've had in mind that you have relationships with and say, hey, we have a few other offers on the table. We just kind of like to feel around what some of the feelings are in the market. Of course, just like any other negotiation, if you're in a point of desperation and you're almost coming off like you have to sell, that's not going to put you in a great negotiating position when it's time to sell this business. But of course, putting the word out there that, hey, we are open to this and we are looking at what our options are, you're going to broaden the parties that could potentially be interested because they might not be coming after you. It's a little different, among the bigger corporations, because I'm sure, Procter and Gamble and Coca-Cola and these guys might know if they're going to buy a much larger company. They already know the, sort of how that would look, how that would shape up. They might not know of the smaller companies, or they might have heard, but they might not know the inner workings of the smaller companies, and that, generally smaller companies are, focused on growing their own business, within. They're not looking at, say, M&A potential. And saying that you're open to it, now some of these larger strategics can maybe start to consider that and put that on their own table, for discussion. Yeah, it's a great point,
I love
Andrew.
that point of, if you do get inbound requests, even if you're not ready to, sell your business, it doesn't hurt to take a phone call.
Yeah.
You could just say, hey, we're not looking to sell our business right now. We're doing great, but be happy to take an introductory call. And then if something changes down the line, maybe you get a really big offer, you can go back to the people that previously reached out and potentially have a full process, that you can run. And by process, I mean, multiple parties to bring
Mm-hmm.
it. So I thought that was a good point.
Yeah, it's in my relatively short stint in investment banking, we'd see a lot of companies that they say, hey, we have this inbound offer, we're not really sure what to do with it. So first of all, let's take a look at it, and now this might open your eyes to, okay, let's see if there's something else out there. Let's go to a few more parties and kind of see how the market feels about your business and see if this is the right time to consider acquisition. And if it's not, at least now we know we can kind of put those in our back pocket and save them for later, of course.
Yeah, totally.
So a few more questions for you here, and we can wrap up, Andrew. What can startups do? Of course, gain some traction, get some good revenue numbers. Other than that, what can startups do? What can founders do to prepare for an acquisition, whether it is next week or 5 years down the road?
Get a good legal team. Um, it's going to be the biggest transaction of your life potentially. Make sure you have a good accounting team as well. All your, tax filings are in order. Um, Even just one thing that I, noticed when I went through my first acquisition was having to go through and collect every NDA I had signed, every document I'd ever, every contract, having all the, and that applies when you're raising, venture capital too, but it might not hurt to just have like a mini data room available at all times if that's your goal, if you're building your company to sell it. But if you're in a position where you're looking to sell it in the next, 30 days, definitely make sure you stay focused on growing the business if you're able to. Have a good legal team behind you as well as an accounting firm if you don't have an in-house CFO or a VP of finance. Those are probably my biggest ones. I remember when I went through my first acquisition, I leaned on my CFO a lot. it was essentially him running the show, and I don't think we would have gotten that deal without him. So shout out to Brian. I still stay in touch with him. He's a great guy. And then also my accountant, his name's Neon from Fernway Solutions. And Aaron Stewart was on the legal side. So just having those people who are going to be so crucial. And again, it shows goodwill in terms of, when you present an LOI and it goes to the stock purchase agreement or the asset purchase agreement, whichever one, you start moving towards, you're ready for that. You're not just like, oh, I'm going to need a month to get back to you on this one, because you want to keep that momentum moving within a buyer.
Yeah, as a finance guy, I love that point. Trust your financial experts. One last question for you, Andrew. If I'm a startup watching right now, and maybe this is something that I've had in the back of my mind, maybe when it comes time for me to look into my acquisition options, and I want to work with MicroAcquire and find out more information about how the process looks like using MicroAcquire, what would I do to get in touch with you or the company?
Yeah, you can just go to microacquire.com, sign up for a seller account. Everything is manually approved by me. So if you have any questions, I'll be there to help improve your profile, explain how the process works. But I try to make the simplest way for startup founders to connect with buyers, whether you want to just test the waters, you need to sell next week, or you just want to get feedback from buyers or build those relationships that, you might leverage years down the road. And it comes at no cost. So microacquire.com, you can sign up and reach out to me at andrew@microacquire.com, and happy to answer any questions you might have.
Incredible. Yeah. Coming from the investment banking world, I think this is an incredible tool for startups to take advantage of when they start thinking, maybe it's time for acquisition, or to at least check out some of the options. Andrew, we can't thank you enough for joining us today. And we thank everybody watching right now for joining us this week for Demo Week. And we will catch you next time. Thanks.